All right, recording.
Okay. Hey guys, this is Tera Stanton, a real estate agent with Rocky Top Realty. Every Monday we've been doing this Money Monday where we talk to you about credit and what it takes to buy a house and what some good tips with your money that you can do to help you be in a position to buy a house. And I've been doing this with my co-host here, Melissa Griffin from the CEO Credit Club. She is amazing at what she does, and I'm going to let you just tell briefly about that, just real quick, Melissa. I know we do every week, but we might have new viewers, so let's just make sure that we put that out there.
On all the bases all the time. So, hello. My name is Melissa Griffin. Like Tara said, I am the owner of CEO Credit Club. So, we are a credit restoration company here in Knoxville, Tennessee. I do service other areas. What we actually do is kind of help you to clean up your credit report, help you to build credit, just really make sure that you're on the right path to raising your credit score and helping get to your goals that your credit is factored into. So, of course, buy the house. And today I'm excited because we're going to talk to you about debt to income. And I'll kind of bring in a little bit about what we do as we go through there, but this is mainly about what you need to be prepared for as far as how much debt you have versus your income, and specifically going to buy a house. So,
yes, good job. So, this is what we're going to talk about, debt to income, right? So, can you tell us what, like the definition, just tell us like what is DTI? What does that word mean? Like, what does that abbreviation mean? And what is it?
Yes. And a lot of times whenever you're talking to a lender or someone in real estate, they are going to say DTI. So just know that DTI does mean debt to income ratio. So specifically what that is kind of what it says. It is the percentage of the debt that you have compared to your gross income amount. So your gross income is like before all your deductions and taxes and all that are taken out. So it's simply the percentage of those two combined together.
The percentage of your debt to your income, DTI.
Yes. So it is, and I'll let you cover kind of where. Do you want me to go ahead and go into what is factored into the DTI, or do you want to kind of get into the numbers?
Well, what do most lenders look for? Let's start there. Like, when you go to a lender and, they're going to say, what is your DTI? And I know, I'll go ahead and throw this in there because I know we talked about this a little bit earlier, that lenders look for a certain percentage of, how much debt that you have, like payments going out, the percentage of payments you have going out, which is towards your debt, versus how much you have coming in, which is your income. And that percentage needs to be a certain number for you to get a loan. And I know that the lenders I work with, it's usually anywhere, depending on the program, depending on the lender, there's different factors. So I don't want to say specifically the number. And then of course you have things like FHA and USDA and all those, and they all have a number that change, that number can change, especially with all this COVID-19 going on. Different things happen with the economy, just different things that get factored into what percentage, but pretty standard around 50%. But some of them want 44. So I'm going to tell you that you need that debt to income ratio to be around 44 to 55%. And so just know that if your debt going out is 55% of your income, then that might be high. It's also getting, pushing it. And what that means is that amount of payments, the amount of payment that you have going out for your house. So like say the house you're going to buy, that house payment has to be within that 44 to 55 range. Now your debt to income overall, that number could be different, and I'm going to let you talk about that, but the amount of payment in your DTI can only be 44 to 55%.
So, and actually to touch on that, so you have there's two different DTIs that a lender is going to look at. One is going to be your front end, and one is called the back end. So what the front end of kind of more of what Tara was talking about, it's going to include that mortgage payment. So your mortgage payment, HOA dues, taxes, and things like that, all that's going to be included in your mortgage payment. That number alone, actually from what I've seen, there's always, like she said, lenders are going to be a little bit different in their specifics, but kind of a basis is the 30% rule. So your payment amount for your home, and even if you're like renting right now, if you've a lot of apartments, they'll say like they don't want the price of the apartment, the monthly amount, to be more than a third of your income. So that's still kind of the same rule that lenders are going to follow, that your payment amount needs to stick below. You really want to try and get it below that 30%. But then the back end, so the back end DTI ratio is going to include all of that. So it's going to be the mortgage plus any mandatory monthly payment. So like she said, those minimum monthly credit card payments, if you have a car payment, student loans are also going to be factored into there, into that, even if you are still in school and they're deferred. So I want to touch on that later too, on how that's factored. But all of that is, like she said, you really want to have it definitely less than 50%. I mean, you would kind of know a little bit more on the lender side if, you know, where the is taking that over the 50%, but definitely below 45 is going to be better. Trying to get that DTI, you really want to be mindful of that whenever you apply for a mortgage. Even if your credit is good, even if you've been at your job for 2 years, you want to make sure that what's going out matches what's coming in.
Right. Would you say that without a house payment, like say somebody's renting or they've sold their home and they do not currently have a house payment, having your debt to income ratio at about a 25 to 30% would be good to go into getting, like, because then they would factor in your home and that would bring you to the 40 to 50% range.
Okay. So while you're renting, understand this. When you're renting and you're figuring your debt to income, you're only factoring in everything other than your rent. Because once you buy a mortgage, that rent is going to change. So if your rent is $1,000 a month, whatever, we'll just use the easy number. If your rent is $1,000 a month and then you have other bills, whenever you go to factor in that DTI, you're not going to count that rent that you're paying, because it's going to be replaced by your mortgage payment. And say mortgage payments tend to be a little bit cheaper overall than what your rent payment is. At least you get more bang for your buck. So
so I know we just talked about it a little bit, and then you just hit on the rent. So can you tell us which bills are included in the debt ratio? Because there's some that are not, and we'll get to what's not in a minute. But what is included? Like when someone's figuring out how much money they bring in versus how much goes out, what do they include in the goes out?
So one of the easy ways to think of what is going to be included are going to be those things that are mandatory, that you have to pay each month, a set amount. A lot of things are going to be reporting on your credit that are going to be factored into that. So, well, definitely anything that's on your credit is going to be factored into that. So you're going to have, like I said, your minimum monthly credit card payment. So they're going to take all of your credit card payments. So the actual amount of the overall debt on the credit card, that's going to play into your credit score. But what's going to play in your debt to income is just going to be the minimum payment amounts. If you have any car loans, of course, those are going to be on there. Any personal loans, really any type of loans are going to be included in that, because it does mean that you have to make a monthly payment on it. Student loans are also included in that. So the way that they're going to factor student loans, there's actually a couple different ways, and it just depends on what status your loans are in. So if you are still in school, or if you're in deferment or forbearance, they're going to look at your, they're going to factor in your student loans by the 1% of the loan balance. So if you have high student loans, though, say you have almost $100,000 because you went to school for a while, that's going to be a lot. Even though 1% doesn't sound like much, it can be a lot whenever it's factored into a monthly payment, especially depending on what your income is. However, there is a way around that. If your loans are too high or if you're in forbearance, you actually want to get those put on a monthly payment amount, and you can get that at like an income-based amount. So it may be $0 to $5. If you could get that $0 to $5 factored into your monthly payment amount and your DTI versus that 1% of your entire student loan balance, you definitely want to do that. So make sure that your student loans are not in forbearance. Of course, if you're in school, they're automatically going to be deferred. There's not really too much you can do about that. But if you're not in school, make sure that you do have a good monthly payment amount. Otherwise, they're just going to take that 1%. Let's see, what else? So car payment.
And that's something you can help with, right? Is if somebody needs to get a grip on their student loans, that's something you can do. I know you've told me about some people that you've helped. So I just wanted to throw that out there. If you guys have issues with your student loans, if they're in default, if they're in forbearance, whatever.
Taxes.
If you're making a payment and you are just struggling to make that payment, then you can get with Melissa.
Your student loan payment, you're probably not set up on the right plan that you need to be. If your taxes are being taken, if your wages are being garnished, if they're in default, any of those we can help with. What we do is we're kind of going to step in, see where you're at, and then we'll assess the situation, tell your options, go from there, and then help you get that taken care of. So student loans is definitely something that we can help you with if
that's good to know.
Yourself in that situation. So
very good to know. Okay, so which bills are not included? Because I've heard from many lenders that they do not look at like doctor bills, different things like that going into your DTI. So can you tell us what is not included in your DTI?
Yes. So what's not included in your DTI are going to be like your utilities. Of course, those are a monthly thing that we all have to pay each month, but it's not a set amount. So they can't factor that into your DTI. Your, of course, like television, internet, things like that, just kind of your monthly other utilities. Your car insurance is not factored into that, because even though it's a thing that you do pay monthly and it is a requirement, at least here in Tennessee, to have, your amount could change. So they can't base that off of the amount. Health insurance and medical bills. So say you're set up with a collection company and you're paying such and such amount on your medical bills, or you're paying the doctor an amount, that's not factored in. Now, if they are in collections, that's going to play a little bit, like I said, into your score. There's a certain amount that you can't go over as far as having it in collections, but as far as the amount that you're paying each month to doctor bills, that amount is not included.
Right.
Cell phone services, groceries, childcare. So I know for me, childcare is a pretty large expense, but it's not included in that DTI ratio, because obviously your kids are going to get older, and throughout your mortgage, you're not always going to have that. So those are the things that are included versus not. Like I said, one of the easiest ways to really kind of know which set you need to put that in, whether it's included or going to be whether it's reporting on your credit or not, and then if those amounts change.
Gotcha. So if, say, someone is over that percentage, say whether they are renting or they've sold their home and they do not have a house payment, and maybe their debt to income is at like 40% already, and they don't even have a house payment, or say they do have a house payment and they're looking at more like 60, 70%, is there a fast way to get that down? And what could we do to help people get that under control quickly? Like what are, and I know that probably depends on the case, so I'm going to let you just kind of hit on that a little bit.
Yeah. So as far as getting it down quickly, my best advice for that would be to, after you figured out what your debt to income ratio is and you come to the conclusion that it's too high, look at those payments amounts that are included, and then look where you can lower that. And that sounds okay, right, but look at it as, okay, obviously a car payment, if you pay extra on this car payment, your monthly payment is still going to be the same. It's an installment loan. Your payment is going to be whatever it is through the life of the loan until you refinance it or it's paid off. So don't worry about spending extra cash to pay off an installment loan. because it's not going to change your debt to income. If you have a credit card payment, the minimum balances are usually based off of the balance. So if you have a credit card payment that has, maybe $10,000 on it or so, I've seen minimum credit card payments be kind of steep, $300 to $400. Well, if you can, I know that's a lot, but anything that you can pay towards that balance is going to lower that payment amount. That's going to lower that. So look at the items in that you listed in the debt to income and see where you actually can change that monthly payment amount. If you can't change it, don't focus on that because it's nothing that you can change. If you can pay it off and that's an option, then, do that if it would help you with your debt to income. But if you have like $15,000, $20,000 left on a car, put that energy somewhere else.
Right.
Obviously looking into where you can lower the minimum monthly payment. But then also the truth is sometimes, guys, you have to increase your income. So it might be that whether it's temporarily or not temporarily, if your debt is just too high to where you have to take on maybe a temporary part-time job to get that paid down before you buy a house, you might have to do that. But then also see if you're able to get a raise if you've been in your position for a few years, or make sure you've been doing a really good job lately. But so kind of see where your options there are as far as increasing your income. Like I said, whether it be temporarily just to pay down the debt or more long-term to actually increase the amount of income that's counted for you. And then that would also reduce that percentage. So kind of looking at that both ways and see which is going to be a better fit for you.
Good stuff. So I had thought of a question a second ago and it left me. Oh my gosh. It was about payment. Oh, okay. So say you've got some cash saved up and say your DTI is high. Do you think, in your opinion, and I'll tell what I think here in a second, but I want you to go ahead and see what, from your professional standpoint, if you've got the money to pay down some of that debt, but that money you were saving up is more for your down payment or closing costs, what would you recommend to do with that money? Would you get the DTI down?
It depends on where you are at. If you are going to be able to pass with where you are, it's not going, because your DTI is not going to affect your rate. Your DTI is going to help you to get approved, but it's not actually going to affect your rate. Your credit score would affect your rate. So at that point, you really want to think.
Which, if your debt to income ratio is high, your credit score will be a little lower, right?
Yes. Well,
so
if your credit utilization, so not necessarily if your debt to income, but if your credit utilization, because your debt to income is going to be things, like I said, like your car payment and stuff like that. Whereas you might have a high debt to income, but your credit card payments are low. Your debt comes from other places. But definitely if your credit cards are maxed out, or if they have a high balance compared to what's available, you do want to get that down. That's going to help you decrease your debt to income. That's going to help you raise your credit score, which is going to get you a lower rate. But if you have a 30% debt to income ratio and you have extra cash, it's not going to make a difference. And your cards are already low, then use that.
I'm talking about the people that are more like 50, 60, 70% DTI.
Honestly, the quickest thing to make a difference is to get your utilization lower. If your utilization is really over 10 to 15%, get that down as close to 10% as you can. Let that be the goal. And then, so if your credit cards are not at 10% or less, yes, use some money to pay those down, because it will help you to boost your score.
So, and this is my take on it. I've seen it literally shut people down. Like you said, it'll matter if you get approved or not. I've seen it shut the approval down. So my take is, if you've got, say, 10% down on a house and your debt to income is at 50, 60, you might want to go ahead and pay that down and try to get it to the 30, because there are programs where you only have to have 5% down for a conventional, which is rare, but you can find it. There's 3.5% FHA. So, you could take the other 6.5% and pay that on your income or your debt. So that brings that utilization down. And then there's also USDA, which is 100% financing. So it may not mean that you are completely exempt from buying a home because you don't have that down payment, because you then took that down payment and paid down your debt. But what it could mean is that, you may have to get these certain types of loans, but you can still buy a house. So I definitely think that before you just do, because I've seen this so many times, like a lot of times you think just paying off your debt is the best thing to do. And I think we've talked about this on a couple of the Zooms that we've done. And it is. I'm a believer in the Bible, and it says that you're a slave to the lender. I believe that. But if you're trying to buy a house and you have to have a roof over your head and you have to be able to do that, you've got to just get in the house and then knock out the rest of your debt. So what happens is you want to talk to the person that you're going to be lending, like that's going to be your lending and be your lender. And that person may say, you need to pay this off. This is what the bank will want. And this other one might say, no, we want you to do this because this is what they're looking for. And then there's always, you guys could go to Melissa and she can absolutely just like whip your credit in shape. So, that is what I would recommend.
Talk to your people though. Talk to
your people before you even just start paying stuff off, because once you've paid off one bill and you should have paid off another, it's like, you can't do anything because the money's gone. Yep. So I have seen that, and I see people do it with the best of intentions, and I totally get it. Or they think, I don't want to have these payments anymore. And they needed money sitting in the bank. And then again, here we go back to that. They had money in the safe and money in the bank, and they took the money in the bank and they paid off the auto loan or whatever loan, and then they kept the money in the safe, and it really should have been the money in the safe paid it off and the money in the bank stayed for the house. So just make sure that you talk to your people.
With what money comes from where and tracking things, especially whenever it comes to large amounts and stuff. So you just want to, like I said, talk to your circle, talk to, your realtor, your lender, things like that before. Yes. If they say your debt to income is too high and we're going to need to work on this, instead of just running off and paying off your car with this money that you have saved up, talk to us. Like she said, send me a message, shoot her a message, talk to your lender, and figure out what's going to be the best way for you to utilize the money that you have that's going to give you the best score, that's going to get you the best loan.
Yes.
So instead of doing something that you thought you were doing with really good intentions to help yourself, and instead, just due to lack of knowledge and not knowing how things were going to be factored and affecting you, you've actually hurt yourself and lost out some money. So
yes, I agree. And another thing is, I just want to throw this out there, that when you talk to a lender, maybe you've already got a real estate agent just ready. If not, I'm your girl. Come get me. I cannot express enough how important it is to have a lender that communicates with the agent and have an agent that communicates with your lender, because we have to do that. Like once a house is under contract, your agent has to get paperwork to the lender. The lender has to let you know where you're at in the process. And I can't tell you how many times that I have worked with my lenders to explain to my clients what is going on and what needs to happen. And there's times where they'll call me, they'll say, hey, they told me this, this, and this. I don't even know what that means. And then I'm like, well, I just want to make sure I get it right. So I call the lender and I get the 411, and then I call them back and I'm like, okay, look, this is what she's meaning, he's meaning, whatever. And then we work through it together. But I have had some situations where somebody just picked a random mortgage company and went and the people didn't do their paperwork. They didn't turn in anything. Nothing went to underwriting. And the whole deal was just blown. Or we had to switch lenders, and it was so stressful because our time was like weeks into this thing. And so I cannot express that enough. And so if you decide to talk to a lender before you talk to an agent, make sure you interview that lender and ask them, would you be willing to talk to my agent and work with, and I don't have to know, and the other agents don't have to know all the confidential details. You don't have to know all of that. So don't feel like all your business is going everywhere. However, if it is, by law, it is safe and confidential with me. When Melissa does her thing, it's safe with her. Your lender is safe with them. However, the communication of this is where we're at, this is what needs to be done. I can't tell you how many times that we do that and work together. So if you go talk to someone, interview them and say, do you have a problem communicating with my agent? And with your agent, saying, can you, do you have a problem talking to my lender? Do you communicate well with your lender? And just go back and forth. And that is just so important. I can't even express that. And I'm sure that if you work with Melissa, you end up working with Melissa to correct some things on your credit or improve things or build credit, that's also going to be important for her to be able to see what the lender wants, or for you to communicate what your lender is saying to Melissa, so Melissa can help you get where you need to be. So I just wanted to throw that out there. That was kind of extra tidbit. That's a free bit of information. We didn't have that planned.
I definitely agree, Tara. And honestly, if your lender is not willing to do that, or if you ask them and you get any type of give back, or I don't know what the word I look for. If you get any type of bad vibe about that, or any where they don't feel like they're going to, or any hesitation at all,
go with your gut feeling.
Go with your gut feeling, because like she said, okay, so there's lender rules, there's rules in my field, there's rules in Tara's field in real estate. We have to protect your information.
That's right.
However, if we can all work together, and I know anytime that I work with the client, even whenever a lender sends me the client, I specifically ask that client, do you give me permission to discuss your credit with this lender? So that that I'm also talking to them. Because here's the thing. If we're all on the same page, what if I'm working on your credit and your lender is about to pull your credit? I know that there's still some work that we need done. And if you pull this credit because you're not ready yet, then that's going to give you another inquiry. I can already tell them where you're at.
Communication. Oh, yes.
So
yes, that's a good point.
That's a really big thing. Some lenders will be like, oh, well, we need to check it now. We'll see where it is here. And every lender, I mean, it's a business. Every lender is different. Some people answer their phone more than others. Some people, the customer service is better. But that's the thing too. Like she said, whenever we're all on the same page, if you talk to your lender and your lender says something like, your DTI is blah, 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 and da-da-da-da, and using all these acronyms that you don't know what the heck they're talking about, that's fine. You can let either one of us know, hey, I talked to my lender. They said such and such. I'm really lost. I don't know what's going on. That's fine. We're already in the situation. We already know what questions to ask, kind of what we need to find out, so we can talk to your lender, get back with you. And I know myself and Tara, like, we are really good at explaining things. If you don't know, that's no judgment. I love to explain things. So
yeah, I mean, there was a day we didn't know. I mean, that's just how it works.
So
yeah, for sure. Good stuff. So, I know that we've done this in the past few weeks, but I just wanted to drop this idea that if you need help getting your debt to income, or you don't even know where you're at, if you've got some things on your credit that need to be repaired and fixed before you buy a home, please reach out to me or to Melissa. If you reach out to me, I'm going to get you connected with Melissa. If that's your issue. If it's not your issue, I would love to help you find a home. If it is your issue, Melissa is really good at what she does. If it's something minor, maybe a month to 3 months. If it's a little bit of work, you've probably got about 6 months to a year, and you can turn it around and be buying a home. And so reach out to one of us, because we would love to get you in the right direction. If you go to ceocreditclub.com, which is Melissa's website, and when you're signing up for her services, use the code that she's given my customers, which is M like move, Y like you, F like forward, because I'm going to help move you forward. So it's MYF 15, the number 15. So MYF 15. And that's going to give you a 15% discount from her services, just because you hopped on here and you heard about her through me. I'm super excited about this. We've been able to send people every single week to her. There's lots of people that are going to her that are just getting amazing help, and they're doing amazing things. And I'm just so excited that we've connected and been able to work together on this. So I feel like there are so many people that I talk to on a weekly basis that just feel like they'll never, ever buy a home. And that makes me sad, because that shouldn't be the case. Like, everybody should be able to buy a home. Home is where you lay your head. Home is where you make your memories. Home is where when you're sick, you don't feel good, you want to go home. Like, home is home. Yes. Yes. Home is where you make your holidays. It's where it's just all the good things. That's home. Home is home. And everyone should be able to have that. And that is just something that I'm burdened for, and that I want to share with people, that there is hope if you feel like you can't. And that is where Melissa is just a godsend, and that she can help with that. And we can turn that around and be house hunting for you within the next 12 months. So I'm super excited about this. And then also, it's a lot. It's a big purchase. It's probably the biggest purchase that you'll ever make, unless you're an investor. You never know what that big purchase is going to be if you're an investor. But as far as just in everything that you buy in your whole life, your house is going to be the most expensive, and it's the most intimidating, and it has the most details. And so sometimes you got to wrap your mind around it before you move forward. And that's what we're here to do, to help. And so next week, I just want to throw this out there as well. We're going to do on Tuesday, because it's Memorial Day, and we want you guys to enjoy your holiday and just have fun with your family and not even think about your credit or buying a house. So on Tuesday night, though, at 8 p.m. Eastern Standard Time, we are going to be on here, and we're going to have some extra guests. And the topic is going to be, if you own a business or you get a 1099, what you need to do to buy a home, because it's a little bit different than if you just have a W-2, and just what has to happen for you to be able to buy your home. So if you want to hop on next Tuesday, if you know somebody that is in business or works for themselves, they get a 1099. They may work for someone, but a 1099 means you don't have taxes taken out yourself. What is it called? Self-contracted? Yeah, you're a self-contractor. So if you know somebody, once we put that out there, tag them so they know. Like, help us get some people on there, because it's a lot harder and a little bit different when you own a business or you're self-contracted to be able to buy a home. So it's not as easy as buying a car or some furniture, or it's definitely, you got to jump through a few more hoops. So we're going to share what to do so that you can be prepared. You may be new to the 1099 world and not even know that, but that's the truth.
That would be a great time to learn, so you can go ahead and learn as you started.
That's right. And that's what we want. We want you guys to know before you get into the uh-oh phase, before you're like, oops, I should have. We want to be able to set you up for success. And that is what this is all about. So thank you guys for hopping on. Melissa, thanks again for being on here this week. You always bring the best information. I'm super pumped about what we have coming in the next few weeks. We're going to have different topics every week. One of those being the business thing. I don't know, I haven't talked to Melissa about this yet, but as I was doing this, we're doing this recording, I have a feeling we might need to do one on student loans alone, like just make 1 week of student loans, because that is a huge one. That's something else I run into every week, is people are like, I have student loans. Do you think I'll even be able to buy a house? So I think that is a good topic that we could bring on. We might do that the next week. So you guys have a great evening. And Melissa, thanks again.
Thank you.